It's Sunday. What's up? Hey, thanks for popping on the channel. What's going on, Janice? How are you? It's good to see you again. Thank you so very much for hanging out in the Dividend Dive. I'm Russ. What's going on? And we're going to talk about whatever the heck you guys want to talk about. Thought I'd say don't mind this little dot on my face. I'm going to educate you all about something what happens when you heat concrete with a torch. So obviously you guys know I weld, I work with metal, and it's called a concrete sprawl, S-P-R-A-L-L, I believe. A little bit of, I don't know, chemistry. So there is water vapor that's inside concrete. And when it heats up really rapidly, the water vapor basically expands into steam and creates a violent explosion when it needs to go somewhere faster than it can escape out of the concrete, and the concrete kind of blows apart and it's really hot. So concrete sprawl, aka for really effing hurts when you have basically burning concrete that sticks to your skin. So hey, now you learned something. You're a little bit smarter than you were when you popped on. So I'm happy to do that kind of things. And hey, hopefully, you know, I don't know if you guys caught my last video. Didn't do very well, but I don't care. I felt like as a card carrying member of the Berkshire, why did I say it like that? Berkshire, of the Berkshire cult, right? I just felt like I had to do our Lord and Savior Warren Buffett proud. So, yeah, I got some pushback on it, and it's been interesting. You know, makes you second guess yourself and think about doing things different. Maybe you should have been more nuanced. I don't know if you guys want to talk about OMAH. I know we had some questions about it, and I've been seeing more videos and more social media content regarding OMAH, the Omaha, the Berkshire Select, or what's it called? The Vista Shares Target 15 Berkshire Select ETF or whatever. Supposed to get a 15% yield. And as I was in conversation with a couple people in the comments, I guess I was completely wrong, off base, misleading people, uninformed, didn't do any due diligence, all this kind of stuff. And yeah, I think if I had to do it over, really, I wouldn't change anything, except I probably would have went a little bit more in depth on the, hey, what's up, Jared from San Diego, Pacific Beach, one of my favorite places. So share your thoughts with some of these covered call ETFs, because yeah, I said it had a 95 Omaha, or I'm calling it Omaha. OMAH had a 95.8% return of capital. And we, as long-term investors, we want return on capital, not return of capital. Return of capital is, okay, not a good thing if it's destructive return on capital. Maybe we're going to learn something here together. So destructive return on capital lowers the net asset value of an ETF. So when a company like Vista Shares has their OMAH and they target 15% yield, right? Well, it's called a distribution. It's not a dividend. So they target 15% annually, and they pay that out monthly. Well, they have that target that they have to hit. And what they're doing is, yes, you get some dividend income, because from what I understand, they are buying the securities, but they're selling covered calls against Berkshire B shares and the top 20 holdings of Berkshire Hathaway. There's stock holdings. So you got like Apple, Coca-Cola, American Express. And you get income. I sold a covered call on Vici Properties this week just to kind of, you know, I got 325 shares or so of Vici, so 100 shares, or we'll see what happens. Anyway, back to our story here. With them selling covered calls, you get premium for selling the covered call options. Now, they will return. That's part of the distribution yield that goes back to you, money in your pocket. And that, from what I understand, can be taxed favorably when it's a return of capital. So the way to think about that is, if the option premium is going to be greater than the target, the 15%, we'll just say annually, 15% that they're going to target returning to you as income. If the bulk of that is return or is option I know it, right? it sounds a little bit confusing. And if you're confused, this is why Warren Buffett would say, if it's complex, just don't even bother with it. So what's up, Steve, Shannon? So the last thing I'll say on that, and then we can just talk about what you guys want to talk about. So when you have these ETFs like JEPI and you see a massive 96% return of capital, a portion of that is going to be dividend and option income. So that will be constructive. It's not destructive return of capital. But when they can't meet that, they're going to pull from the net asset value. They're going to pull from the fund and return some of your own money to you. And that's when you see the net asset value of a fund dropping. So, you know what? I got you guys right here. We'll look at this real quick since we're on it. So this is, let me throw myself. Yeah, we got that. Stop sharing. Un momento, por favor, because yours truly shut it. Like, hey, look, did you catch that? It was up on screen for half a second. All right, this is what we wanted. So this is on TradingView. Am I zoomed in here? No. So this is OMAH, and on TradingView, you can go and click on net asset value, and right down there, you'll see year to date, negative 2.11%. So that means that's destructive return of capital. I don't care what anyone says, how nuanced they want to get. You know, if they want to hit me on telling y'all it's going to rain, but not explaining the meteorological, microbiological conditions that are actually forming the rain that's going to be hitting you. But the fact of the matter is that year to date, now, yes, 1 month it shows 5.34%. It's up. That's good. That's a good thing. And then let me see if I can get to the big one here. You know, we love TSLY from YieldMax, right? So look at their net asset value. It's down here at the bottom. Now, the fund came out in November of 2021 or 22, November of 2022. So it hasn't been a full 3 years yet, but just in the past year, 38% net asset value decline. That means that their premiums and dividends and whatever, everything that they're bringing in is not covering that super high yield that people are buying it for. And it's just giving you a portion of your own money back. So with all that said, you know, I guess, you know, they could have dinged me on that. And I should have done a little bit better job explaining that and kind of glossing over saying that you're just getting your own money back when you see that 96% return of capital. But, you know, even then, I still covered myself on that because as long-term investors, I hope a lot of you are long-term growth investors like myself, following in the footsteps of Warren Buffett. What really made him wealthy was that compounding effect. That's why Berkshire's never paid they did pay one dividend in 1967 of 10 cents a share when Warren said he was in the bathroom, right? Kind of pokes fun at himself. But Berkshire's paid one dividend, and they are one of the best performing equities, probably I don't know if it's all time. I think I saw a chart once that I think Altria and one of the oil companies might have been the best. But yeah, that and then when you get that return of capital, I guess I'll just, you know, if you're confused, I apologize. When you get that return of capital, you kick the can down the road on paying taxes. You don't have to pay taxes on that until you sell, kind of like with a master limited partnership, like an EPD or an energy transfer. It lowers your cost basis in that holding. So whatever, if you buy in at $20 and you get $10 worth of distributions, right? Your cost basis is now $10. And if you were to sell at $20 again, sometime in the future, then you're paying $10 on that, from what I understand, because that's the difference between your cost basis. So, yeah, that's if it was a good thing, they're charging a 0.95% expense ratio, really high. And, you know, I guess, guys, you know, it's just the 35 of us, and I've been droning on for almost 10 minutes now, but you can probably tell it bothered me a little bit. So, you know, my intention when I have somebody telling me that I was misleading, I don't understand what I'm talking about, that you got to be careful when there's YouTube channels like mine that are misinforming and misleading people. It bothers me a little bit, right? and it's not intentional if any of that happens. So I think I was going to say one more thing on that, but yeah, Shannon, shortcuts to wealth. That's what I was telling you guys about, was how Warren Buffett got rich. You want to retain as many profits as you can. If you can turn $1 into more, that's Warren's market test. If you can turn $1 into more than $1 of market value, it doesn't make sense to give the shareholder their money, because that dividend also is double taxed, right? The corporation pays tax on the profit, and then you pay tax when you receive the dividend. So it's kind of a double tax. Dividends are tax efficient, which is why if Warren has his choice, he would rather just keep reinvesting at really high rates of return and compounding. And as I said, I'll be in Indy next weekend, but it's kind of like when something's paying so much of its money out as dividends, they're not reinvesting into the business, right? It is kind of an admission that the business that's paying the dividend is really big and they have no better use for that money. So they're going to pay it out to you in the form of a dividend. But when Warren Buffett is at the helm, and the guy's, he's a genius. He's a financial genius. When you have him handling money, by the way, charging you no fees, nothing. You just hold the stock, watch the price go up. That's why he said then you will be further ahead if you just sell little bits of Berkshire when you need the money. And that's also one of the reasons why they went with the B shares, to also make it kind of easy. They had a conversion process when they came out in the 90s with those B shares, where you could change in your A shares for some B shares, but it was a one-way check valve. You could never go the other way to convert Bs into A. And, it's, we want our money compounding and growing. And when these covered call funds, they're giving you a lot of money back, even if it's gains on the option premium, that's not being reinvested into the fund. So you're trading current income, you're trading future growth, potential future growth for current income. And that's pretty much antithetical to what Warren Buffett would look at as compounding your wealth. So I could probably go on for another 25 minutes, and I won't, but what do you guys... So what do you guys want to, Cody, what's up, man? So I'm glad you liked it. And you know how it is, dude. Cody's another YouTuber, Citizen of the Year. Definitely check him out, write it down, do what you can. But he, I don't know. There was a lot there, and I'm sure there's some stuff I missed, but I think you get the gist. There's a price to pay. There's no free lunch on Wall Street. These covered call ETFs, yes, a lot of people get what was that? Weird. Sorry. My curtains it sound like a window closed over by me and my curtains were moving. Okay. Suddenly I'm turning into Cole Sear from The Sixth Sense. If you start seeing me talk to somebody, telling you I see dead people, right? I referenced it in my newsletter, and now the spookanannies aren't happy with me. But what was I saying? I don't know. Maybe that was a otherworldly clue, like somebody with the old-timey vaudevillian coat hook or big cane pulling you off stage and reel it in. So let's see. I'll talk a couple of these. John, I didn't buy UNH. Dude, it's so tempting, right? We were talking about it last Sunday right here with Craig. $380 a share it was. It hit 250s, but there's just so much uncertainty. I've never dove deep into UNH. I'd love to know what you guys are doing with it, but dude, Cody, I see your comment. That's the point I was going to make, is that there's no free lunch. And if you want a 15% yield right now, you're going to pay with future growth. It's just the way it goes. And I think a lot of newer retail investors focus on that yield and not on the total return. And every time, you guys know I did that video, when you compare the total return I'm trying to think of the ticker for the Yield Max Netflix, NFLY. I don't know. There's always a Y in there somewhere, but either way, almost every one of the Yield Max funds underperforms its reference asset on a total return basis. And Netflix doesn't pay a dividend. So isn't that crazy? You got a fund paying you, I don't know, right? Sometimes people are like, it's 80% yield. I'm like, yeah, but a lot of that is you just getting a significant chunk of your own money back. And that's going to, it's not outperforming the reference asset, and they don't even pay a dividend, which is why I said it's like one side is running a race with their shoes tied and the other one is in an Indy car. I'll be in Indy 500 next weekend for the race. Excited. My daughters are going for the first time ever. So we're going to see that. But John, I know, right? This guy's like the micro machines guy of investing. So myself, I guess. But John, back to UNH. I'm holding out. I know Joseph Carlson made the point and said about you want to invest ideally in companies that people love to use or you love to use. Again, back to Netflix. We enjoy it when we turn on Netflix. It's a pleasurable experience. I enjoy going to Costco. By the way, I just got my upped membership renewal for Costco. It's going up $5 to $130. We get the executive upgrade we got, right? Because we get 2% back. Got a check for $128. That's good at Costco. So kind of offset it almost exactly. Weird, but we enjoy going to Costco. I don't know. Maybe I'm getting old. That's something old people do. But who enjoys UNH? When do you look forward to saying, oh, sweet, I get to deal with UNH? Plus, this is our first year with UNH at my employer. And I've heard more than one person say, effing UNH sucks. I hate UNH. Or, hey, can we go back to our Blue Cross Blue Shield because my other doctor was a network, or they didn't deny this. So I haven't heard anything good about UNH, which kind of makes me a little bit uneasy if I'm investing something for the long term. But with UNH, there may be, from that Wall Street Journal article that said there's Medicare fraud. They're being investigated by the DOJ. The thing with that is that's a significant part of their revenue. And from what I understand, if UNH is found guilty of Medicare fraud, they can't participate in Medicare for 5 years. And, if that'll be augmented or challenged, I don't know. But if you're looking at no revenue from UNH from Medicare for 5 years, that's nasty. And I don't know if it'll come to that, but there's just so much uncertainty around this company right now. I'm just going to sit it out. I mean, maybe if it gets stupidly cheap, like under $100 or something, maybe I'll take a bite on a few shares, but I think it's over 3% dividend yield for the first time ever, I read. So yeah, John, I'm not, I guess we could do a lookup. No, we did it. We looked it up before. I'm sorry, man. Put it this way. We said it was a solid business. It makes a lot of money, but that's where it is right now today. And when we invest, again, yes, it's important to look at the past. We want to see where the company's been and where it is today, but that tells us not exactly everything about the future. The windshield on a car is so big because the future is more important than the rear view mirror, right? I'm sure somebody out there's got a troll comment about why it's better to look in the rear view. I don't know, but yeah, you want to look through the windshield. And right now it just looks really, really murky and cloudy and uncertain to me. So, and here I am, right, in Nexstar still. But honestly, I've been trying to reconcile that one, going back to some of the Buffett and Munger quotes about being invested in a declining business. Sometimes you can get a lot of cash from them, but they're not growing. So they're really choosy about being in declining industries and businesses. So, all right, Cody, yes, do it, dude. I wouldn't only go in on OMAH. I would tell you to put all your family's money into it and borrow, max out credit cards, get the reward points, whatever you have to do. Joking. Nobody do that, please. Brett, yeah, are there any covered call funds that don't? I've looked at a few. I think it's just how they work. And you also have to ask yourself, right? I'm a welder, retail investor. This is a passion of mine. I love learning, getting smarter, hopefully not misleading and confusing anybody. I'd like to be thought of as a teacher someday, like Warren Buffett, famous Charlie Munger quote that said something like, until they've learned, you haven't taught. So if you're teaching something and the people you're teaching haven't learned, it's you. You're a bad teacher. So yeah, Brett, I think it's just the nature of the beast. They all have these giant outsized yields that attract people, mostly retail investors. But the funny thing, why don't any of the professional fund managers invest in these things? And if you guys know of any, let me know, because I sure don't. I sure don't see a Guy Spear advocating for an OMAH or a JEPI or, and again, I think JEPI, right, is one of the more solid ones. But again, they all use derivatives. They all have a higher expense ratio. I don't remember what JEPI's is though. But you know what? Like you said, Shannon, dude, I think people want to get rich quick. It's in our human nature to want to get rich quick. And when you want to get rich quick, you are making yourself susceptible to people just selling you what you want to buy, selling you what you want to hear. And I think that's where a lot of people can get tripped up. So, yeah, Cody, we'll see, man. Just because an ETF has done well the 6 months, it'll do well forever. And that's what I've said. One of the commenters said, 6 months from now, you're going to be comparing it to Berkshire. And I said, you know what? I'm just going to bet on Berkshire because they're keeping all of their retained earnings and reinvesting into the business or sitting on that cash in treasuries, which, by the way, yields might be over 4.5%. Holy smokes. Moody's pulled the AAA credit rating from the United States government. It was the last AAA rating, right? I think Fitch downgraded a few years ago. S&P, I think, was 2011. They downgraded, but it's not good. It's not good. There's too much debt, right? It's getting bigger. The annual deficits are growing. The distance between the revenue coming in, it's just getting wider, and they really don't see any coherent, logical path toward shrinking the deficit, and that's a big problem. I think that's probably, that can't go on forever, and countries have ended because of that. So, yeah, Frank, it should be okay, and I hope it's okay and works out. But I'm just going to steer clear. I mean, yeah, I'm tempted by, I should do a quick swing trade or this or that, but the same way you don't do Mo, Altria, I wouldn't do UNH. They're letting people die. And I think it's telling. The Luigi Mangione, was that his name? I don't remember. The guy that killed Johnson, the insurance CEO. He murdered him, and I think it's telling the amount of favorable opinion of this guy, like he's some sort of a hero. He killed somebody in cold blood. So what does that tell you about the state of the insurance industry? It tells me that, I think I heard that Luigi's defense fund is now been donated over $1 million, with the average person donating $20. So people support what he did. I don't support what he did. I do think there needs to be reforms. And I don't know. It might be right. We're all worried about the Trump pharma, the most favored nation. And then everyone saw that, it's voluntary. I mean, it's like, like a toothless dog or something, going to gum you to death. Yeah, no one enjoys talking about UNH until they need it. And then when you need it, it's never an easy process. I know we've dealt with insurance and, no, Mr. J. So that is the Wall Street Journal. It came out. When was that? Was it Friday or Thursday? I don't remember. Maybe it was, I think it was Thursday. The Wall Street Journal was reported that they were under investigation by the DOJ, and basically United Health said it's fake news. They vehemently denied it. So, dude, if maybe I should. That's funny, Cody. Yeah. I should just completely rip it. But honestly, I don't know, whatever. I guess I felt more, I don't know the word I want to use, but for 4 years now, somewhere around 4 years, I've been pretty intently studying Warren Buffett, Berkshire, Charlie Munger, my guys, listening to every annual shareholder meeting twice. I'm slowly making my way through the annual shareholder letters, which they say if you read the first 30 years, you're basically getting the equivalent of an MBA. We'll see if that's going to be the case. But yeah, I just felt like it just feels wrong. It feels wrong attaching a 15% yield to Berkshire. And I know the one commenter said, they said that the whole goal of of OMAH is not to outperform Berkshire Hathaway, but I think I have a feeling a lot of people are buying it because they think, OMAH, Berkshire Hathaway, Warren Buffett, 15% yield, buy. That was kind of the whole reason I wanted to make it, to just be like, hey, I don't think this is going to work out, and it's not what you think it is under the hood. Yeah, what's up, Jason? You think covered call ETFs definitely are not for the young investors looking for total return? They're not. They're not. I concede that. I can see retirees looking for that, right? But as I said in the video, even then, Warren Buffett wouldn't recommend retirees go out and buy a fund that has a high expense ratio that kicks back a lot of your own money mixed with option income from covered calls. And those covered calls, by their very nature, limit the upside potential. So if we're in another raging bull market, your upside potential is limited. But yeah, Chris, whatever. If you're up, man, that's dude, I love it. Charlie Munger called Bitcoin rat poison. And so far, you know what? I like to laugh, but so far Charlie's been wrong. He's been dead wrong. Warren said Bitcoin wouldn't end well, and I don't know. So far it's gone. So far it's gone well, and it is, I don't know, but we don't know. If it ends poorly in 30 years, was Warren right? Maybe. See, that's more tolerable. Jeppy's expense ratio is 0.35, and I wonder if I can bring it up on this. Let's see if I can see what their NAV has done. Here we go. Let's find out together. I didn't scroll down yet. Let me bring you guys along. Yes, Cody, I am going to the 500 this year. So, yeah, Brian Thompson. You're right. Did I say Johnson? I said Tom. Or I said Johnson. It's Thompson, right? That's what you get when you're motor mouthing. And it's funny, as somebody who talks a lot and does this, it does kind of crack me up, Cody, when people will nitpick something you said, and it's like, well, when somebody like a Joe Rogan is just talking so much, like you can't every single word. Anyway, where were we? I was showing you JEPI over on TradingView, and let's get a peek at the NAV. Yeah, okay, so this is not as bad. It's still negative. I don't know if you guys can see this. I'll bring it up a little bit more. This is on Jeppy. So the year-to-date net asset value has dropped 2.24%. So, I mean, correct me if I'm wrong, but that tells me that if you were holding from the year-to-date, you've gotten 2.24% of your money back. So that's not terrible. But yeah, so it's been minimally destructive return of capital, and you want to look for a net asset value that's stable or rising. So over a 3-year period, and I don't remember how old Jeppy is, but it shows 0.46%. Interestingly enough, just like OMAH, it shows a big on the 1 month, but I like looking over long-term, even a year, just because the sun made a full revolution around no. Oh my God. I guess I'm back in heretic days, right? Of Galileo. No, just because the earth made a full revolution around the sun. I know somebody's in the comments already like, this guy's saying that the sun goes around the earth. Yeah, if I want to believe that, I believe it, huh? But yeah, just because the earth made a full revolution around the sun, I don't know why that should tell you everything you need to know about a business's performance. But hey, that's the way we think, right? Anyway, so there you go. Jeppy, not too bad. Not like, what was TSLY again? Do I have it up? Here, TSLY. Now, see, there you go. It's green for the 1 month. So that's OMAH, JEPI, TSLY. They're all green net asset value over the last month. And that could be from new fund inflows. I don't know if that's exactly why, because people putting more money in, but then I don't know. Now I say that and I'm like, oh, wait a minute. For TSLY, hold on, everybody. If their net asset value went up 25% in a month, but in 3 months it's down 22%, and then 35% year to date. Doesn't that kind of feel like a Ponzi scheme? Like, are they kicking out new money coming in, going back to, I don't know if they're creating new shares. That I didn't look. So this is all just my wild speculation. And there it is. You heard it here first. All the all the yield max ETFs are a Ponzi scheme. Now, I don't know if that's true, but sticking with the sleep well at night mode, toll booth companies and solid ETFs. Well, Mr. Ski, share a couple of them, would you? Hey, Paolo, what's up, man? Tony, yeah, somebody brought that up in the chat or in the comments. I have to get back to them. GPIQ and GPIX look like the best so far. I haven't looked into those. My guy, if you saw the Rockstar Dividend Investor, oh my God, I'm so sorry. This isn't good. Why am I blanking on his name? Hold on. This is really embarrassing. My friend up in Minnesota, the Rockstar Dividend Investor, plays in the symphonic power metal bands out of Europe. Holy cow. It'll come to me. I can't believe this. Jonah Weingarten. I'm so sorry, Jonah, if this gets to you, man. That's concerning to me. Why could I not remember his name? Maybe because I've never met him like face to face. I don't know. Patel, what's up, man? So you work in the insurance industry in the prior authorization side. When I worked at UNH, I worked commercial plans. The denial rate was high. Yeah, it's funny. I saw that chart that UNH's denial rate is double the national average for health insurers. So yeah, not good. But then CVS Medicare approval rate about 60. Yeah, that's not great, man. And I don't know. I saw some posts from Canadians, and I didn't realize it that you guys north of the border. Where's Shamir? What happened to Shamir? Did he just ditch my channel, or does he still go on talk to Ryan? Have any of you guys seen Shamir? But yeah, in Canada, your tax dollars are your insurance premium. So yeah, they call it free healthcare, but your insurance premiums go to the government, or no, your tax dollars go to the government. The government provides the health insurance or health. It's not insurance, just health care. So just a different way of doing it. Yes. Janice, you forgot the why, but I'll forgive you this one time. Studying Warren Buffett and read all 30 years is better than an MBA. I don't know about better. Yeah, maybe you're right. Could be. We'll see. I'll let you know someday when I get there. Charles, you're getting back into Chevron. Yeah, they've taken a little bit of a hit. Yeah, Jan, I'm trying to invest in those good companies and quality and find them. I'm trying to learn better to second guess myself. Again, going back, reading some of my Buffett and Munger talking about being very selective and picky about declining businesses. Yeah, I'm second guessing Nexstar. I mean, it's been 3 years almost that I've been invested, and share price is just chopped sideways. So I'm thinking about, we just had Option X. So the bulk of options expire on this last Friday, the third Friday of every month. And I'm thinking about selling a really aggressive covered call. And if it takes me out of it, takes me out of it. But I'm thinking maybe I should, I'm at 123 shares. Maybe I should scale back to like 50 or something. But I think it's just an economic reality. Cord cutting is here. I have a hard time envisioning a future without local broadcast television, but look at my kids. I was thinking about my 16 and 17-year-olds. They don't watch the news. I used to watch the news. How and why? Because I used to wait for sports to come on. So I would sit for like 20 minutes through the news to local Chicago news to see sports. Not anymore. I don't even watch local news here. So yeah, I'll be there next weekend, Cody. So I'll go with my kids. And yeah, I don't know if I love it, David. Great quote, David. In case anyone's eating, I won't put that on. They can read the comments. But Cody, yeah, I don't know if I'll be streaming next Sunday night. If not, I'll do it Monday on Memorial Day. And if any of you are around, cool. But we'll see, because the way we do it is we go down Saturday. My friend his aunt lives in Indy. My friend grew up there. We'll stay over at his aunt's. It's a fun party. Her and her neighbor, they kind of almost have a shared yard, and just everybody goes there. There'll be like 15. It looks like a tent city. There'll be like 15 tents up. You just pick a spot, fire, hang out in the garage, and then Sunday we pack up the tent and go to the race. And then after the race, we head back to Chicago. It's like a 4-hour drive. So I don't know. Usually I get home with time, but we'll see. And David, I don't remember if he said that about Bitcoin. I guess I should know better. How is that going to affect stocks? Well, if they were in any chance of defaulting on debt, foreign companies might not feel as comfortable, or foreign entities might not feel as comfortable, I think, about putting money into the U.S. stock market, which would obviously, if not as much money is going in or you got net inflows coming out, if the tide reverses, that's going to lower the U.S. stock market. But the way I look at it, hey, we're still the biggest here, the biggest economy. A lot of innovation happens here. A solid business is still a solid business regardless of the debt. I still think, Procter and Gamble still going to sell their products regardless of what the federal government's debt situation looks like. And if they can't, then I think we got more stuff, bigger things to worry about than our stocks. So, oh, dude, that's how I feel. And on that point, I still don't think I was wrong. I think I should have explained return of capital better, maybe been more nuanced about it. And I wasn't, and I guess I'm guilty for that. So, currency conversion. That's interesting. So you probably have favorable currency conversion, right? Have you guys heard about these reverse Yankee bonds? I guess more companies like Google or Alphabet and I think Microsoft, they're dropping bonds into Europe because interest rates are lower. So they're borrowing money from Europe essentially. So I thought that was interesting. But yes, 49-year-old buying JEPQ for more income. No, you know what, man? I don't. Just as long as you understand that, and I would, compare. So what is the JEPQ's reference asset to? I don't think it's a reference asset to anything. I think they just have a basket of synthetic derivatives they sell. The long-term total return is not going to be as good as the S&P 500. So I think if you just understand that you're limiting upside potential and total return for current income, that's up to you to say. So that's interesting, Jim. I love your thoughts, Jim, because you're where most of us want to be. Alan, I don't. I actually haven't even thought about 3D printed homes like Lennar. Are those the ones where they print basically the parts, kind of almost like I just had a thought of when my kids get Legos, right? They're just going to ship a whole entire house that's 3D printed. I don't. I guess if there's a demand for it, right? Maybe if there's not enough houses being built and it's too expensive to buy a home from somebody, because we got like the golden handcuff mortgage. We're at 2.25%. We're not selling. So I don't know. Maybe if it's cheaper, it's more affordable and people don't mind. So, Alan, just like all things, that's for you to decide. If you think that there is going to be a market demand for 3D printed homes, then, I could tell you, I don't think there will be, but what do I know? I don't know. That's a good point. That was a great way of me saying, I don't know. You like that? Jim, you're retired and you have a position in JEPQ. Oh yeah, that's the Qs, the covered call ETF on the Qs, right? Leaning more toward preferred shares and closed-end funds. Yeah, and that's interesting, man, because with the preferred shares, like Agree Realty has them, you're higher in the pecking order. But I know we talked about it, right? I think I trashed preferred shares too in one of the newsletters, because it's like they don't give you the share appreciation that the common stock does, but there's no dividend growth. like the also common stock has, or you're lower in the pecking order also as the bondholders, right? So preferred shares are kind of like in between, uh, bonds and the debt holders and the common stock shareholders. But if you're retired, man, that's a whole different ball of wax. And if you just need that stable income and that's all that you're really concerned about, there you go. Oh yeah, we asked about Shamir. Nice. Good. I haven't seen that guy in a long time. Hey, what's up, Adam? Hey, yeah, I saw you responded about that thing. We can collab, or I actually meant it as you. I said you're the best, and you said tell my wife that. So I meant like, all right, when do you want to set the conference call up so I can tell your wife that you're the best? Paulo. Yeah, I haven't. Oh, there he is. George, what's up, man? Well, I guess, I mean, my cost basis now with dividends received is down in the like $138. I'm up, I don't know, 10, 11% on those shares. So it's been good so far. But my old friend George, or Jorge, however you want to be called. Yeah, Paulo, with Lionel Bazel, so I just have more thoughts, George. I mean, it's not a bad company. They're facing sector headwinds, right? And they're trying to navigate them. I know you're probably going to bring up the Grizzly reports, the short report, but yeah, Paulo, as far as LyondellBasell, from what I understand and why I got out of LyondellBasell is because they're so tied to a commodity that when there's a shift in that commodity, that's what really affects their business. Because quite honestly, right, they sell like polyolefins and different chemicals or different, right? They do like plastics. I think they manufacture compounds from oil. So if oil's down and whatever, the commodity that they are tied to is down, it's not going to be as good for them if there's not as good of a demand. So it's a commodity risk, I think they call it, right? When you look at a company like LyondellBasell and why other similar companies are down too. Like Dow Chemicals down. That's another one, because whether it's, I think, lumber, steel, polyolefin compounds, do you really care what kind of steel you get? I'm sure, yes, there's some that have to have a certain steel, but for the bulk of people, you go to Home Depot, you're just looking for the cheapest 2x4. You don't care if it's Boise Cascade or if it's Georgia Pacific. I don't care. I'm just like, I need 2x4s. What's the cheapest one? So that's kind of that issue with that. But, I think they were well run. And I think, Paulo, that's why they filed for bankruptcy in 2008, 2009. They went through bankruptcy. The shareholders at the time got very little after everybody else was paid, if anything at all. I don't know. And then they, yeah, I know. They, they've came back, and this is the LyondellBasell that we see today. That's off of bankruptcy. Who's that? Me? Oh, Adam? Yeah, I'll be going to London and Scotland. We leave June 9th. So, yeah, is it 2.5 weeks? Jesus. Or is that you? I don't know. Maybe we're both flying. But we, holy cripes, Steve, you're right, man. You know what? I'm going to break right here because I'm pretty much almost caught up. I'm so sorry, Steve. My apologies here. Let's do that right now because I completely forgot. You see, you get me fired up about something. And here, we'll do a real quick version of the news, Steve. And this is, again, everybody, if you're brand new tuning in, Simply Safe Dividends. So you pay a pretty penny for Simply Safe. I like them. I think it's well worth it. And let me do that. There we go. So pause it if you want to look at it more in depth. I'm going to just blow by this. TSMC, they got a dividend upgrade. Nice to see, from 62 to 70. Main Street Capital, they refreshed their outlook on them. They've done nothing but just pay me lots of special dividends, lots of distributions. So love them. There you go. United Health, they did get a dividend downgrade from 90 to 80. So to the 80 area of safe. I think that's the lower end of the safe bucket. Maybe not. Maybe 75. I don't remember. Either way, a lot of problems, a lot of murkiness in the future with United Health. And this was the last one. Dick's Sporting Good. A little bit of a head scratcher. I guess they acquired Foot Locker for what, $2.4 billion, and they got a dividend downgrade from it. Not exactly sure why they did that. I guess they said so they can go international or get more exposure national. So hey, thank God that was a short news, because I needed it quick. I almost forgot. Thanks for letting me know, dude. I must be growing on you like a weed, George, huh? You're back. All right. Do the... Oh, that's right. You're going to... Wait, where are you going? Are you... Tell me, Adam. I don't remember. Tell me where you're going. So the 3D printing, though, they print on site with concrete. Huh. I'm very interested in that. I might want to watch that. So what do you mean at my age it's almost irresponsible, George? I mean, it's paid me, I don't know. I mean, probably a couple $1,000s in dividends at this point, maybe over the couple years I had it. So I'm not sure why it would be irresponsible at my age. Almost every metric you look at, they're a cash flowing machine. They have a free cash flow yield, not now, but when I was buying back in the 140s, which they've chopped right really hard. They've been in a really tight trend for the last 4 years between the the high 140s and the low to mid 180s. Yeah, they've gone up and below there a little bit, but they are, they're well run, and the whole consternation around them is because of the industry that they're in. So they're a cash flowing machine, lots of free cash, as I just said. They're buying back shares almost like they're taking the company private. Oh yeah, I did buy let's see. Oh, the Bear Cave. I didn't see that, Steve. I'll have to check that out. Back into Pepsi. It's fine. That's all. I think it's just, I don't think you're going to see any crazy growth. Yeah, as somebody that rode it all the way up to almost $200 a share, sure, I wish I would have sold there. But you remember we sold our 100 shares at $158. And even then I thought, like, man, this feels kind of low to be selling. But, we don't know the future. But yeah, as far as Pepsi, I think they're just going to sell. They're just going to shrinkflation stuff. They're going to sell. And Ramon LaGuardia talked about it on their earnings call, saying that they are kind of downsizing the package to meet the consumer where they are. If they're having less money and they want something not as many calories, then they're going to just sell you smaller packages, probably for the same, almost the same amount. But Alan, you got 80 SCHD and SCHG. That's a nice compliment. You got the higher dividend yield and dividend growth with SCHD, and SCHG is all your growth stocks. So I've got SCHG for my daughters in their portfolios. Yeah, you know what, man? Russ at DapperDividends.com, Alan. That'd be cool. I love it. This is what's so fun about investing. I love learning new things. I've never seen 3D home being printed on site. So that would be cool to see. Yeah, it's not number one in my portfolio, George. It's number here. I'm not going to show you guys my numbers, but I'll tell you what it is in my complete net worth portfolio. Let me get to it. Nexstar is, where did it go? Here it is. Nexstar is the the fourth largest holding of my entire investment net worth portfolio. And the biggest is DFUSX, which is the S&P 500 mutual fund version. I'm almost 200K into that. So that's the number one. And then number two is VVIAX, the Vanguard Value Index Fund. So Nexstar's number 4, and then SCHD is number 5. So it's not number 1, not even close. So yeah. I think my wife said, does that mean they're going to call them dick lockers? And I said, I don't know. That's pretty good. Maybe. And it's not your fault, man, but age and time learning about the markets, better said. What's number 3? Number 3 is the FSMDX, which is a mid-cap fund. And let's see, where did I close it? Here we go. Yeah, FSMDX, the Fidelity Mid-Cap Fund. And that one right now is about $13,000 higher market value than my Nexstar position. So, like I said, it's number 4. And of my overall net worth, I think Nexstar is like 4.5% of my investment net worth, not because I'm not including my house, not including anything else like that. Yeah, it's my number 1 single stock. So if that's what you wanted to get at to nitpick, I don't know, feel free, have at it, man. But again, it's money can be made in declining businesses. And again, I'm always open and crazy. Is it really crazy? I mean, a 21% free cash flow yield. Free cash flow is not declining. Their shares are declining, So, no, dude, come on. Crazy would be MicroStrategy, or if anything, Nexstar is a melting ice cube. And if you guys listen to Scott Galloway, dude made a ton of money off of freaking Yellow Pages because he said everyone thought they were a dying and declining business, which they were, but they still spit out a lot of cash. So, hey, you're entitled to your opinion, man. And my God, imagine if Nexstar went to 0 tomorrow, that'd be like 4% of my investment net worth and probably overall net worth. I don't know, maybe 2%. So it's not really, but hey, you know what, man? It's fine. You want to go ahead and nitpick. The Simply Safe score is 65. They give it borderline safe, but Simply Safe is a third-party opinion, and they have to give it that because they have higher debt, but they can cover that debt with their EBITDA. And yeah, 65 safe, the dividend score. I mean, I may trim back a little bit up here because it's been in the 180s. Or when it gets to the 180s, historically, it sells off. I mean, dude, if it was a horrible company, would 98% of institutions hold it? And I understand a lot of people they don't want high institutional ownership. So almost everything between management and institutions own almost all the outstanding shares. Let me look. I don't know. Are you on? Is it 63? Did I get it wrong? I mean, it's 60. I just invalidated everything I said. It's 60 borderline safe. So you got me. You got me, Jorge. No, it's 60. So, and I agree, Kevin. Jorge pops in, a couple times a year, wants to get under the skin, and I think your best hit though, Jorge, was when you said a true veteran would never own Nexstar. I have no idea how you arrived at that conclusion other than to try and piss someone off. So that's kind of cool of you, I don't know how what a true veteran would or wouldn't buy, but good on you. I guess then you're in a roundabout way saying that I'm not a true veteran. So if that's the case, then I don't know, call stolen valor, on it. But you do you, man. Is it really though? Why do you say high institutional ownership is irrelevant? Because institutions control bigger blocks. If they decide to sell, that's going to affect the share price way more than hundreds of thousands of retail owners with a stock selling little bits here and there. So that's why when there's high institutional ownership, it can make share prices swing in a lot greater direction than when it has a low institutional ownership. So is that wrong? Why do you say? Pray tell, Jorge, why is high institutional ownership irrelevant? Yeah, I don't know if Kevin answered this, but he he bought UNH, and Kevin, I thought of you, man, because remember you live streamed on Tuesday night, so you bought it at like what 300, like just over 300, 310, 320 or something like that, and then the very next, no, 2 days later, I think it was 2 days later, it went to it it went to 250s. I was like, Kevin, but now we've bounced right back up. I don't know. I guess why would they exit? If many institutions hold things for income, I think they're predominantly holding it for income, which it does pay predictable income. Again, yes, is portions of their business declining? Yes, they're trying to grow with the digital, with CW, News Nation, The Hill, those things. Obviously, the bulk is from retrans fees and from broadcast television, linear television, but they're trying to get into the skinny bundle. When you have the skinny bundles, they're still part of that with their broadcast, which is why they're trying to buy more stations. They're going after deregulation, right? FCC Chair Carr, that I think they're waiting on one more commissioner approval, and they could get removing the station caps where right now they can't own more than 2 of the top stations in a market. So if that happens and they go on a buying spree, they can have more affiliate stations for the CW. They're trying to get the CW to be the 5th network, right? You got ABC, NBC, CBS, Fox, and CW. Yes, it's laughable. Okay, it's small. They got stuff like NASCAR Xfinity Series and WWE Next, but everything has to start somewhere. And the fact is that the CW was a freaking joke. It was playing scripted shows. They're switching away from that, going to tons and tons of live sports programming. So they have a plan in place. I still think it's well managed, and I don't know. Apparently you think they're Kodak. So, but still, it's a shifting market, and their biggest segment is declining. And will they be able to significantly navigate before the ice cube fully melts? That's to be seen. You don't know the future. I don't know the future. Nobody knows what's going to happen. We all can make our opinions, and that's what makes investing and life so much fun. Will Cruise, what's hate work? Nice name. Will Carnival Cruise ever reinstate its dividend? Yeah, I don't know on that one. I haven't really looked into them. Professor's G Fund portfolio. Oh, that's is this we're talking Nolan Gavaria Professor G or Scott Galloway Professor G? They both go by Professor G. Your kids have SCHD, G, and D. SCHG and SPLG. Yeah, at this point, Kev, I mean, dude, you're in it. It's, if you can, it, that business better than I do. So, well, dude, all right. I know what you're doing, but I'm not going to be, I mean, it has to be vanilla here. I mean, for Christ's sake, I was a sailor. You don't think? Put it this way, George. I was a sailor, and I've worked construction for 26 years now, almost 26 years. But in this medium, there's something to be said for that. You don't want to be foul-mouthed all the time. Somebody much wiser than me once told me that people that curse often, it's a sign of low intelligence because they can't think of any better words to use. So when you hear somebody cussing constantly, there's times like if you get a sewing machine dropped on your foot, there's a time and a place for a cuss word. But if it's just all the time when it's unnecessary, yeah. And their free cash flow payout ratio is low, and it's not for everybody. And hey, you know what I mean? Like I said, I'm thinking maybe I should pull back and slowly build up again just to take profit. And if I'm wrong and it goes way up to 250 a share, if it gets there, if it ever did, okay, so what? I still have some. Getting these groups to learn and collect. Yeah, no, that's fine. I can take it, man. But I agree. Like I said, I don't know everything. And I always tell you guys, this is a passion of mine. I love learning from you. Hopefully, you can learn from me. We can share stuff, share ideas. I don't know. This goes by quick. This goes by quick. This sure does. But oh, Adam, nice. You bought. Oh, okay. First, Charles, you. So Nolan G. Yeah, it can get confusing, right? Because there's two Professor G's. Hey, many of you might not even know Professor Scott Galloway. But if you get the newsletter, I did introduce. He was on My First Million. I kind of like those guys. Sean Purry, he's funny. Bought a little UNH, 10% of what I'd be willing to buy unless it starts to look like it could delist it. Or yeah, I don't. Oh man, I can't. It's the largest health insurer in the United States. I could never see it get delisted, but dude, if they do get found guilty of Medicare fraud and they can't participate in Medicare for 5 years, I think that's going to get ugly. I don't know where it's going to go from there, but all right. Charles, your army. Nice, man. Well, I don't know if you were an officer. Many of you might not know this. And I don't even know if you guys did this in the army, but we didn't salute other enlisted personnel. I assume it's the same, right? You only salute officers. It's a sign of respect. You're saluting the uniform and not the person wearing it. In the rank that they are. That's what you're saluting. So there you go. A little bit of trivia. Enlisted personnel, at least in the Navy, don't salute each other. Oh my God, you're right, Alan. Yeah, so real quick here, let me just get to the end of this. And non-commissioned officer. So then, yeah, I would have saluted you if we were in uniform and covered. That's another thing about the Navy. You didn't salute unless you were covered, unless you had a hat on. I don't know what PED. Didn't we talk about PED? Yeah, that was the penny stock, dude. Michael, again, I haven't looked into it. I'm really skeptical of penny stocks. You want to talk about manipulation? There you go. That's penny stocks can easily be manipulated. And again, penny stock is anything under $5 a share. I don't know why they gave it that definition, but they did. I don't know CNC off the top of my head, but CVS, yeah, a lot of upheaval in the healthcare industry, and I don't know. They've got something that Walgreens doesn't. They're in a little bit better position, but did they take? I don't know. We'll look. Well, maybe next time, Michael Anthony. I gotta. All right, you're welcome, and Charles, I'm glad we went with you. So thank you for your service. We really do appreciate that, Charles. And hey, hopefully you had a good time. Hopefully you learned something. I know rambled a lot. I was like the Micro Machines guy today, but as of next week, programming note, I don't know. It's either going to be Sunday night or sometime on Monday. But if Kevin, I don't know, maybe I'll go on your channel, Kevin, or something. We'll see. But anyway, I'll put word out because I'll be at the Indy 500. So hey, I hope you guys have. Let's see what happens in the market this week with the credit rating downgrade, and I will talk to all you guys in the next one. See ya.